You may have heard the word taper tantrum flying across. But what exactly does it mean and why does it matter to you? Well, the taper essentially refers to the US central bank cutting down on the bond purchase programs, which in turn did infuse a lot of liquidity in the market. Many are also saying that this could be considered as a precursor to the US central bank cutting interest rates. Now, the US central bank is one of the most important ones out there. It does have a ripple effect on the US dollar and, of course, on fixed income around the world. So you, as a debt fund holder, what should you watch out for? Here's my colleague Alex in conversation on just this topic. Take a look.
So as we all know that Fed minutes pretty much suggest that sometimes during the later part of this year, the Fed will announce the tapering. Now we know that the inflation in US at present is around 5.5%, 5.4% to be precise. And there are enough indications now that the inflation might have peaked. And we have seen some of the commodity prices correct in the last 3 months. We have seen the oil prices, for example, come down from 80 to 65, etc. And therefore, a number of people feel that maybe the Fed will, maybe or maybe not hike rates or taper, that means reduce the bond purchases. My view is that yes, inflation might have peaked, but still inflation has gone up enough for the Fed to start the tapering sometimes in the December or January, maybe a little earlier. Multiple Fed governors of different states have, made comments in the recent times, which suggest on a cumulative and aggregate basis that we should expect some sort of Fed action soon. The most likely action is that Fed is right now buying about $100 billion of bonds every month. That may be reduced gradually. Maybe it will be reduced to 100 billion or 80 billions to start with and so on. Now, what does it mean for the markets in terms of the yields in the global markets and in the domestic market? As far as the global markets are concerned, we have seen that the 10-year US yield has gone up from 0.5%, which is 0.5%, to 1.75% when the markets were still kind of, judging as to how far the Fed will go. And now that the Fed commentary is clear, the 10-year yield in US has fallen from a high of 1.75 to 1.25. So in my view, at around 1.25%, the 10-year yield in US is discounting the first Fed rate hike. Now, as and when the Fed starts the taper, I think the shorter end yields will go up. Now, what does it mean for India? In India, we need to remember that when the yields were going up in US, that time RBI intervention meant that the local bond yields remained, basically frozen at around 6%. And therefore, I believe that as the Fed gets closer to the taper, the domestic bond yields in India may inch up slightly. So what we have right now is maybe about 6.25% on 10-year. It may get closer to 6.5% by December when we have better clarity on how the Fed is going to react. Domestic inflation will also be a factor because India is a country with a current account deficit. And as the COVID wave settles down, and we are seeing the numbers begin to stabilize and come down even in state like Kerala, the economy is likely to pick up, the demand will revive, and therefore our current account deficit is also likely to pick up. So as a country, our dependence on the foreign capital flows every year, the Fed policy is directly going to have an impact on our markets, and that may also lead to RBI reviewing its policy stance at some point in future. So net, to cut the long story short, if the Fed is going to start tapering and start hiking rates following that, then we should expect our domestic bond yields to also start inching up. Thank you.
Okay, so that's very nicely presenting the picture when you look outside into the Indian markets. But specifically, we're talking about monetary policy here in India as well, Mr. Jajoo. You had the RBI Monetary Policy Committee latest minutes of the last meeting where you had one dissenter. You had one panel member talk about the fact that there should be more attention being given to inflation, which has been very sticky, particularly core inflation. And therefore, they have said that you should be looking to increase the reverse repo rate. Does that indicate to you that you need to gird, you need to prepare for higher yields, and what effect will that have on debt portfolios?
So as far as the Reserve Bank is concerned, as you mentioned, that there is one dissent and 5 people in support of the policy accommodation. But I think it's just the start of the reversal of the trend. Obviously, there is a the very urgent need to continue to support the economy, and therefore a low interest rate and easy liquidity environment is warranted. But it is also constrained by 2 factors. One we discussed in the previous section, where India is a country which is a large dependence on the foreign capital flows. If the global interest rates begin to go up, then India has also to respond to that. And second is the domestic inflation. Now, so far during the pandemic situation, the Reserve Bank maintained an extraordinary stance and continue to support the growth via the low interest rate and high liquidity scenario. There is one dissent by Dr. J.R. Verma, which very clearly lays out his argument that even if you continue to support growth, you need to check out the ultra loose monetary policy component, which was due to the COVID situation. Now, COVID situation has improved significantly. The risk of the third COVID wave is still there. But I think looking at the current situation, action is required. So my view is that it is a messaging mechanism from the central bank. We have one member who has dissented to continuing with the accommodative stance. We have another MPC member, Asima Goyal. She spoke about how the normalization of the liquidity can be conducted without hiking interest rates. So if you look at the monetary policy, and I think there has been too much focus on one dissent, but I think the broad messaging of the market is that RBI at the core has maintained its accommodative stance, but they have put up everything on the table, whether you call it reverse repo rate hike, whether you call it a repo rate hike, whether you talk about liquidity normalization, or whether you talk about reviewing their accommodative policy stance. And our core projection for the inflation, even if you look at the RBI policy, is around 5% for the full year FY22. It's 5.7, and then even in the first quarter of FY23, they are projecting an inflation around 5%, which means that the directional movement in the interest rate next should be higher. So one thing is clear, that the interest rates have possibly bottomed out. There is an excess liquidity in the system right now, which can, when the demand revives, trigger an inflationary cycle. And therefore, I believe that if the Fed were to follow up on its current guidance of beginning to taper, then I think it's a matter of 3 or 6 months where the Reserve Bank will also respond, and we will possibly see interest rates go up.
Okay. So maximum by next year, middle of next year. I do want to come to the last part of this conversation, Mr. Jajoo, and unfortunately, I'm going to have to rush you a little bit because we're running a little short of time. I'm talking about strategy. Now, I'll give you 2 scenarios. One in which you have an individual who is saving for a specific event that is up to 3 years from now. And in that sense, a lot of advisors would say you should invest in debt market. And the other is simply from an asset allocation standpoint, a certain amount of money is going towards equity and a certain amount is going towards debt. In these 2 scenarios, what should the strategy be as far as investment into debt is concerned? Do you stay on the low end of the spectrum as far as maturity is concerned?
So let me take the second part first. People who are investing in debt funds with an asset allocation perspective, they need to worry about the asset allocation, because for them, the immediate outlook on the interest rates or immediate outlook on the other asset classes like equity is not so relevant, because they are really long-term investors. Now, what is the long-term pattern of the debt funds in India. On a long-term basis, let's say if you look at 20 years, 10 years, 5 years, debt funds have given somewhere closer to double-digit returns. And that, in my view, isn't going to change. When the interest rates go up, there is an immediate, kind of dip in the NAV of that fund because the bond prices will go down, etc. But if one is investing from a long-term perspective with an asset allocation approach, then if the NAV comes down, then they need to do cost averaging. And honestly, I mean, in my view, it is when the interest rates are high that the fund managers get the opportunity to invest new flows and the existing maturities into high-yielding assets. So therefore, for investors with an asset allocation approach, I think they should look to do nothing but remain invested, and if the NAV comes down, they should rebalance the portfolio periodically. For people who have up to 3 years investment horizon, they need to look at their respective liabilities, obligations, the purpose why they're investing, because they're more susceptible to volatility in the debt fund. Therefore, I think if people have 6 months to 1 year investment horizon, they should look to reduce the maturity of their funds, or they should shift to funds with lower average maturity like liquid funds or ultra short duration funds. But people who have closer to 3 year investment horizon, I think they should again remain invested, because they will continue to be invested for one full interest rate cycle over the next 3 years, and therefore I think they will get good returns. So to summarize my views, I think people with asset allocation approach and 3 years and above investment horizon, no need to do any action. People other than that, they need to review, maybe bring down the maturities of their investments. Thank you.
Absolutely. Thank you so much, Mr. Jajoo. It was a little bit of a tough question that I asked you towards the end, but you summarized it brilliantly. It's been a pleasure speaking with you, and I look forward to doing so once again.
Thank you. Thank you for inviting me today. Thank you.